Dividend and share repurchase policy. When a company generates cash from its operations, the management has to decide what to do with that money. Basically, they have three alternatives: to fund the investments, to pay back their loans, and to distribute cash to its shareholders. And there are two ways how they can distribute cash to their shareholders. First, they can pay cash dividends to their stockholders, or they can repurchase their stocks. By buying back their stocks, they distribute cash to the shareholders. A firm's dividend policy determines how much cash to pay and when to pay that cash. When the financial year is over, the company decides, or the board of directors decide, how much cash payments they have to, or they want to repay their shareholders. Let's say the company made $10 million in net income, and the company decides to pay $4 million. So basically, 4 out of 10 million is spent for dividends. That means the dividend payout ratio is 40%. All right, let's assume the dividend per share is $2 and net income is $4. To find the dividend payout ratio, which we can do is, we can basically, so dividend payout ratio. Payout ratio, okay? By dividing the dividend per share by net income, we can find out that the dividend payout ratio is 50%. Now let's consider dividend payment procedure. The dividends are declared, let's say, on the February 4th. That is, the board of directors formally declares how much and when to pay the dividends. If it's the February 4th, there is a date of record of, let's say, February 13th. This is the day when all transactions take place, and whoever is on the list of shareholders on this date will be eligible for dividends. Whoever is not in this list will not be eligible to dividends on this day, on March 1st. But what is Exdividend date? So usually it takes 2 days for a transaction to take place. If you want to become a shareholder and entitled for a dividend that is being paid on the March 1st, you have to make sure that you are on the list of shareholders. If you buy the stock after or on this ex-dividend date, you will not be entitled for a dividend because it will take 2 days and you will not be entered to this book of shareholders. So that's why ex-dividend date means you bought the stock but you're not entitled to the dividends of a company. But if you buy it before this date, any day before February 11th, this is called cum dividend date, which is the share that you bought will be bringing you dividends on March 1st. Therefore, what usually happens is that close to this date, all the stocks, the price of stock increases. The price of stock increases here, and once it closes, the price of stock goes down on this date. Because it will adjust for, and usually the difference between this loss will be equal to the dividend, let's say, to the dividend per share. Dividend per share. All right, so that means people will try to buy, will try to give extra money, will be ready to pay extra money to be entitled for dividends. But after the ex-dividend date, they know that they're not entitled for the dividends that are coming on March 1st, and the shareholder or the investors, they will not be ready to pay so much money, and the prices will go down. And we can look at it from any for any company that pays dividends, and but it's the amount of loss here, the amount of decrease in price is usually equal to dividend per share. Let's say if the company is paying $2 per share, $2 per share here, dividends, and let's say the price of one stock is, let's say, $25 here, and the investors will increase the price. They will be ready to pay, let's say, $27, and they will be ready to pay $27 here. And once the stock is bought and the dividend, ex-dividend is over, you will not be entitled for a dividend. You will again drop to $25. Of course, it's a very approximate number. Sometimes it can be a little bit more, sometimes it can be a little bit less, but usually the market corrects itself when the market closes here and opens on the next day. So therefore, there is a very little room or almost no room for arbitrage here. Okay, another way of distributing cash to its shareholders, other than paying dividends, is repurchasing its own stocks. And the companies can use 3 methods to repurchase their own stocks. So the first one would be open market repurchase. And this is usually done when a company wants to repurchase or buy back their shares from the market. What they do is they basically ask the brokers to buy back shares every day by a little amount, so that it doesn't really interfere the market or change the prices very drastically. And another one is the tender offer. When company wants to buy back their shares, what they do is they make a tender offer, and usually they offer the shareholders to sell their shares back to the company at discount. Let's say the market price of a share is $15, and the company says that it will buy back a certain amount of shares at $13. The third method of buying back the shares would be purchasing from one or major shareholders when they find it's like a private placement, but the other way around, right? So they basically go and talk to one of the main or large shareholders and negotiate the price and buy them back so that they have less shares outstanding in the market. Okay, sometimes companies don't want to spend cash on dividends, but what they can do is they can offer non-cash dividends or non-cash distribution dividends in the form of stocks, right? Stock dividends and stock split. So let's talk about the stock dividends. Instead of paying cash dividends, companies decide to pay dividends in stocks. For every 10 stock you own, you will get another 1 stock. That means after the dividend, you will get 11 stocks. Okay, now talking about stock split. What is stock split? When a company decides that the price of their stock is too high, they decide to decrease the price by splitting the stocks of all shareholders. Let's consider a company whose stock price is $1,000, and it may not be very easy for all the investors to buy a stock for $1,000. And what the company does is it splits into 2, right? So instead of 1 stock, they give you 2 stocks, and each will cost $500. And at the end of the day, the company will double the number of shares it has outstanding, and at the same time, the price will split into two. The price will go down twice, and the market value of the company does not change. So this one is called two for one stock split, meaning you are giving two stocks instead of one. So replacing two stocks and giving one. And about the stock dividends or stock bonuses, what happens is they don't take your stocks back, but they give you extra stock. So this is the only difference between these two strategies. Now let's consider this example here. Current price of a stock is $8, and the company offers you one stock for every 4 stocks you own. So one stock bonus issue, right? So 1 for 4 bonus issue. What will be the new price after bonus issue? So imagine you have those stocks and you're getting one extra stock for every 4 stocks that you own. So what will be the value of your 4 stocks at $8 per share? That's going to be $4 multiplied by 4 stocks multiplied by $8, and you're going to have $32 worth shares. Now the company is adding you one more stock. That means by adding any stock to you, the valuation of company is not changing, meaning the value of the company will be the same, or the value of the stocks that you own will be the same, but you will have more stocks. So in order to find the new price of a stock after the bonus issue, what you have to do is you have to divide the value of your stocks by the new number of stocks you own. That means 4 plus 1, you're going to have $32 divided by 5 stocks, and the new price of a stock will be $6.4. So the price of the stock will go down from $8 to $6.4. Now let's consider another example with the stock split declaration, right? So the current price of a stock is $200, and the company believes that the price of a stock is too high, and not everybody can afford buying a stock for $200, right? And the company says, declares a stock split of 4 for 1 stock. That means they will take they will replace 4 stocks. They will replace each stock. They will replace your each stock with 4 new stocks. To find out the new price of a stock after the stock split, what you have to do is you have to divide $200 by 4, which means instead of 1 stock that costs $200, you're getting 4 stocks, and you're going to end up having 4 shares, and each costing $50, and the value of your stock holding will be the same as it was before the stock split. Now let's consider the case of timing of dividends. The company has 2 alternatives. We will talk about the first alternative now. So the company has $35 million cash on hand now, and by the end of the next year, they will have $135 million. What will be the value of cash dividends that they will be paying today and next year at this amount? So let's consider that they pay all the money they have, they pay all the cash they have on their hands today, and at the end of the year, they will generate more cash and they will pay it out as well. So, and the required rate of return for the investors, for the shareholders, is 15%. Now, to find the value of alternative 1, what we do is we get this $35 million plus 135 million next year, and we discount this money cash flow using the 15%, which is 1 plus 0.15. And if we discount this 135 million, $117.39 million, $152.39 million. So this will be the value of the company when it pays available cash today of 35 million, and next year whatever is available of 135 million. Under the second alternative, the company wants to increase their dividend payment by 50%. If they have available only $35 million on hand today, they want to increase it by 50% and pay $52.5 million today. That makes it $35 million available, and they will have to issue a new new stocks of worth $17.5 million. As the company issues stocks, this is a cost of equity. That means the cost of equity is equal to 15%, because the shareholders' required rate of return is 15%. So for the company, the cost of new equity will be 15%. That means when the company generates new cash from their business of 135 million, they will not be able to pay 135 million because they will have to return this 15%, return this new issue, return this money due for their shareholders plus the interest. That makes it 20.125 million. We will have to subtract this amount from 135 million that will be available for the company next year, and they will be able to pay back $114.875 million. So next year, instead of 135 million, they will be paying out $114.875 million. So this is the difference between two alternatives. In alternative one, they are paying whatever is available and they're not issuing new stocks. And the same year for the next year, they're not issuing any stocks, so they are spending 135 million from their operating cash flow. But in the second alternative, what's happening is that they want to increase the amount of dividends they want to pay now by 50% and ending up paying 52.5 million. And because they are issuing new stocks, they have to make their stockholders happy, and paying 15% on that, which leaves them 135 million minus $20.125 million, which is equal to $114.875 million. Now let's calculate the value of the company now. The value of the second company will be $52.5 million paid today plus $114.875 million discounted using the 15% interest rate, $99.8913 million with $152.39 million. So as you can see, in the first alternative and the second alternative, the value of the firm does not change. no matter how, no matter when we pay and how much we pay the dividends. The value of the firm will not change. And that's why the theorem introduced by Modigliani and Miller is called the dividend irrelevance theory. Thank you for watching the lecture, the video about the dividend policy. If you have any questions, please make sure you leave them as comments below.